Welcome to FounderLine, the show where we answer your questions about startups. I'm your host, Joe Beninato. Thanks for joining us. It is great to have you all with us. FounderLine's all about helping people with their startups. And you might be someone who's thinking about starting a company and you have some questions, or maybe you're in the midst of running a company and you have some challenges you want some help with. Maybe you're an employee who's thinking about joining a startup and you want to find out some information before you accept an offer. In any of those cases, we want to try and help you out today. This is a live show, which means we're available right now to take your questions, and we'd love to hear from you. The best ways to reach us are by emailing us to help@founderline.com, and you can also tweet at us. Our Twitter handle is @FounderLine. With that, let's get started. Our guest today is Josh Stein, who's a partner at DFJ. And Josh has funded a bunch of great companies, including Box, Chartbeat, TalkDesk, and Yammer, which was sold to Microsoft, right?
Yeah, although Yammer, I got to be honest, I can't take too much credit for Yammer. We were in that for 4 months.
We still give you credit.
Oh, thank you.
Anyway, welcome. Thanks for joining us today.
Thank you.
Great to have you here. So usually we warm up. I'll ask you a few questions just to get you going, and then we'll go see if we can help some entrepreneurs out.
Cool.
So my first question, I love having people on who have been startup founders and executives, and have done it before they went into the world of venture capital. So, how does your experience starting a company and being involved in multiple companies affect your daily life as an investor?
Yeah, so I think it helps if the companies weren't especially successful, and so I had the great timing to start my own company, which was called ViaPhone, which is actually a DFJ backed company, in 1999, which was a really great time to start a company. It wasn't a great time to run a company for the next couple of years, and then we learned some pretty tough lessons before we sold it in 2002. Which that included, both the .com collapse, but also 9/11. So that was kind of a tricky time to run a company, but it taught me a lot. And I think, as a VC, I think one of probably the biggest things is having a sense of empathy for what the entrepreneurs are going through and some of the pressure that they're under. I remember being on that emotional roller coaster, right, where the highs are really high and the lows are really low. Where everything's tied up in kind of your company. One of the things that I actually learned about myself in the process is that that was so hard on me that I kind of thought, hey, I'm more interested in the investing side, where you're still involved in the companies and you still feel some of that, but like the amplitude of that sine wave is lower, and you have multiple waves because you have a portfolio. So what I find is, at any given time, usually, one or two of my companies is doing incredibly well. One or two are not doing as well, but it kind of balances out. But I think, when I'm working with an entrepreneur that's maybe having to do something like, let's say, a RIF, a reduction in force, or dealing with some really big customer issue or competitive issue, having been there, I just think, helps me understand what they're going through and maybe be a little less clinical about it.
Yeah. And that's a huge deal, because as you know, like when you're sitting in that CEO chair, it's tough some days, right?
Oh yeah.
And the hardest part is when you have investors who are like beating you up as opposed to trying to be a part of the solution, right? And you got enough going on. Like the last thing you need is somebody beating you over the head while you're trying to do a riff or whatever. So
yeah, no doubt. And actually, it's funny. I was lucky. I had pretty supportive investors. I was actually more me beating myself up more than anything else. But the other thing I think really helps a lot is so that was what almost I guess 15 years ago now. And then before that, I worked at a company called NetObjects, which was actually a very hot company. It was, I think, the largest Series A for a software company at the time in 1997. And then the company went public in 1999 and actually did reasonably well before it kind of then faded away. But you had incredible people that worked there. So between NetObjects, very short stint as an intern at Microsoft, working in Expedia when it was about 50 people.
Wow.
And then starting, well, that was a very cool experience. And then starting ViaPhone and having maybe, I don't know, 200 people work at ViaPhone at one point or another. I found that I formed this sort of base of people that I had kind of been in the trenches with and knew very well. And it's amazing how those people are doing incredible things now. And so, I find that that then gets amplified as a VC with either founders I've worked with or people like you that I've bumped into over the years, and we've just gotten to be friendly, or people that have worked at the companies that I've backed. But that network of people, it's amazing when you get. I'm 42 now, and I feel like the network effect has really started to kind of exponentially kick in.
Well, and that's the amazing part is you keep running into these people and they're doing amazing things, right? That
totally
you didn't even know about, right? And we haven't seen each other in 10 years, and now you're running whatever, right? So
I think it's the coolest part of the Valley is how Parker Conrad at Zenefits would be a great example. I got to know him when he was right out of Harvard and doing his first company, and that company, he had a pretty tough run there. It didn't go that great. And then, getting to watch him now at Zenefits, where he's just, killing it, and just, it's one of the legendary companies. It's really fun, and I think it's, it really pays to get. There's amazing people in the Valley. You get to know them. I love people. I think sort of a culture of people trying to help where they can.
Yeah.
And then, if you do that for 10 or 15 years, it's amazing how kind of all that stuff accrues up.
And a lot of people talk about can you replicate Silicon Valley elsewhere?
Right.
And I think that's one of the key pieces that's hard to replicate is, you can have your HBS friends or the people that you went to Columbia with, on the East Coast, but here it's sort of like you work at this company, there's a network of 100. You work at this other, and then they start to overlap, and that's the amazing part is just how connected everybody here is.
That density. Yeah.
And you walk down the street in South of Market or Palo Alto or wherever, there's 6 startups forming as you're walking by, right? So
you get that in smaller regions, and in some ways it's tighter. Like Seattle is one where there's a really tight community. But kind of basic network effects, basic network laws is the more nodes you get, the network goes exponentially more powerful, the number of nodes. That's everyone's always trying to copy Silicon Valley. I don't see it. I think if anything, Silicon Valley's become more predominant. I think the experiment of trying to export Silicon Valley has actually, I think, waned rather than increased in the last 5 years. That's my personal belief.
Yeah, no, I totally agree. And people are always asking me like, oh, should we move there? And I'm like, if you can, yes.
Yeah.
If you have 30 employees with families, it's going to be much harder. But if you're 2 guys who just graduated from college and you're in New York, maybe it could work in New York. If you're in Florida, you should probably come out here.
Florida's, I've done deals in Florida. It's tough. Just to recruiting alone, the talent pool. The good news is when you get people, you tend to hang on to them.
Yeah.
The cost is lower, but it's a much shallower talent pool. Silicon Valley, I think, is number 1 with a bullet. Order of magnitude bigger. I think the other viable regions in the U.S. would be New York, Seattle, and LA.
Yeah.
Interestingly, Boston 15 years ago you would have said was number 2, and I think Boston's just fallen off the map.
I hear of
which
nothing.
Is crazy.
I know.
If you think about the schools that are there.
I know. Wow.
Some of that's just cultural. I think it's this kind of New England skeptical culture that I think never really kind of embraced the rest. There was some of that actually I'd lay at the feet of the VCs that were there, and many of the traditional Boston firms have actually kind of repotted to Silicon Valley. Greylock would be a great example.
Yeah.
Battery.
Yep.
What's the other one that I'm thinking of? Right to my tongue. Anyway, they General Catalyst, right?
Yeah.
Where the kind of center of gravity has actually moved out west. But it was a much more kind of risk averse. How do we control what could go wrong? How do we put kind of restrictions around the entrepreneurs rather than the Silicon Valley altitude, which I think is how do we enable this thing to be as big as it possibly can be?
Yeah, and I've even had talks with the people at MIT. As an alum, I want to see more of a connection with them.
Yeah.
And it's kind of non-existent out here. I'm like, there's an alumni association that has hikes and pizza parties and those sorts of things, but there's not as much of a how do we get teams coming out for the summer and doing internships, and they've been very slow to sort of pursue that sort of stuff. I don't know if it's Boston pride or what, but
I think what you're going to see is there's going to be there'll be some new discipline that I think will I'll give you an example. AR VR. I think right now Seattle is doing some of the most interesting stuff. So if you look at Microsoft HoloLens obviously, but Valve with their new system.
Yeah.
So I think what you'll see is there'll be some
like a vertical,
and then like, you get that kind of thing. Or LA, I think with LA and New York with media, you're getting that thing. I mean, if you're doing anything related to advertising, New York is actually arguably a better place to be right now.
Right.
Yeah.
All right. So one of the companies I wanted to chat with you about was Box, and you were one of the first investors there.
Yeah.
And I always love to hear stories of like, how did that investment come about? Like, how did you meet those guys? Yeah. What was it that like told you, oh my God, I got to give these crazy kids some money? Like I don't remember how old they were at that point in time, but
it was Aaron and Dylan and Jeff, and Sam was the fourth co-founder, was actually just joining right about that same time, and all four of them were classmates at Mercer Island High School up in Seattle, and they were 19 to 20 when we backed them, so pretty young.
Were they in college, or were they?
They had dropped out of college.
Okay.
So Aaron had dropped out of USC, and Dylan was on a leave from Duke.
And they were all back in Seattle.
No, actually, so you asked how I met them and what. So the first clue I had was, this is the great thing about a venture firm, which is we're a partnership. And so I have this incredible partner, Emily Melton, who has just a huge she's incredible nose for deals. And I don't know if you remember back in the day, Mike Arrington used to have these barbecues at his house.
Yeah.
So Emily was at the barbecue, kind of getting to know people. And I think the story is she bumped into Aaron and Dylan literally like in line for beers at the Keg, and just kind of struck up a conversation. And I had done about a year and a half before that this deal called Sugar CRM, which was one of the really early kind of SaaS deals. It was kind of, SaaS was just sort of coming together as a word. And she came back the next day and she's like, I met these incredible guys. You gotta meet them. So met them that afternoon, and they had a working product. They had about 10K in MRR. And more importantly, they were just awesome, right? I mean, you spend any time with Aaron, and he has matured incredibly into this like kind of leader in the community. But even then, they just had this kind of energy and enthusiasm and passion. And one of the things I remember distinctly of that first meeting, actually two things. One was, DFJ's mantra is think big. We're sort of looking for opportunities that if they work, how big can they be? And the thing that always struck me about Box was the horizontal nature. It was almost like email. So it wasn't something that would be used just by dentists or doctors or salespeople or marketers or lawyers. It was something that could be kind of this horizontal thing where you can imagine everyone would have need for this storage. The other thing was, I typically, if a meeting goes well, send founders follow-up questions by email. So we had a great meeting. I sent these guys like that afternoon. I sent them a list of like 7 or 8 questions. And I get this email back at like 2 in the morning, and it's like a 6-page, incredibly thoughtful set of written responses to the questions I'd asked.
Wow.
Yeah, and that's like a great sign.
Same day.
Same day, right? So it was like, so it just, this whole thing moved really fast.
See, if it were me, I wouldn't have wanted to appear too eager, so there's no way I would have responded the same day, but it had the opposite effect for you.
Oh, totally.
Okay.
Totally. No, because I mean, like that's, motivated and they're on it. And actually, there's a lot about the Box financing that I think is different now, and in some ways it's better and in some ways it's worse. And one of the major ways is Box, we were the only investor in what was called the Series A round at Box, but today would have been called the seed round. So it was $1.5 million, and it was a 4-person team with sort of an MVP and just a very basic. They're about 10K in revenue per month from there were about 1,000 consumers paying $10 a month roughly.
Wow.
Right, and so you'd call that probably like a seed round today.
Absolutely.
And a lot of these seed rounds are done, and there's great funds, but a lot of the seed rounds end up being kind of not really led by any single investor. It's more of like a party round.
Yeah.
And so as a result, you usually don't have like a functioning board, and you don't have someone that's working really, really closely with the team. So, for the next year and a half, we were a major investor in the company. I would get together with the guys at a board meeting once a month, which was just the 3 of us. Probably talk to them, 2 or 3 times a week. And I feel like the connections that we formed then just laid the groundwork for this incredibly successful relationship over time and allowed us to really dig in and help the company. And so there's, all of the credit for any successful company should go to the entrepreneur, and especially for Box, because the Box team has navigated more kind of twists and turns than almost any company I can think of. And the grace and poise with which they did that is incredible. Like, consumer to enterprise transition, and then, from really kind of small, medium business to like real enterprise, like big enterprise kind of transition.
Yeah.
But that was something where we helped them. So like there was a point at Box where they'd gotten to about, I want to say about 2 million in ARR. And, you know, I was talking with Aaron and I said, hey, you know, kind of, have you thought about going after the business segment? And we kind of got to that by a discussion of saying, well, you know, let's talk about who are the customers that are really good for us and who are the customers that are not so good. So who are the customers that, you know, stick around and don't churn and maybe pay more and use more of the service, and who are the people that are not so good? And you could tell pretty quickly that it was like people who were uploading videos and MP3s, you know, they used a lot of storage, but also they tended to not upgrade to our paid plans. And they kind of just like put the files there and left them, which is just like terrible because you're taking cheap desktop disk and turning it into server disk.
It's like Google Drive.
Yeah, and then you had customers who would be putting up like PowerPoints and Excels and Word docs, and they'd be sharing them with people, and those things aren't that big. And more importantly, the intensity of their usage was way, way higher, and they never churned. And so that was kind of like the first thing of like, well, could we maybe make this more businessy? Well, what would that take to make more businessy? And then, you know, they just ran with it. But like, you know, I think that entrepreneurs are, the good news for entrepreneurs is I think you're getting a relatively less expensive capital. Yep. But I also sometimes wonder, are there companies that, you know, don't end up being successful that could have been because they don't have someone who is as committed helping them? It's like, it's different to have 20 people that are kind of loosely connected to your success versus somebody who's really, really invested in your success. Yeah. I always tell people, by the way, like there's sort of a sense of sometimes with entrepreneurs, I was guilty of this when I raised 3 rounds of venture myself, that you want like the senior partner in the firm. I was like the junior partner in the firm when I did the deal. Junior partners can be great because like I was all in on Box, right? It was only $1.5 million investment for the firm, which isn't a big deal for the firm. But for me, for my career, I was heavily, heavily invested in their success. Yep.
Well, and I always tell people it's all about the partner you end up with.
Totally.
And
yeah.
like, what are their incentives? What are their motivations? What do they like to be within the trenches, right? So you obviously, early deal, you're trying to make a name for yourself. Sure. Like you're going to work your ass off to try and make that company successful. So.
Absolutely. And you know, like, you know, Box had its own version of kind of 9/11, the financial crisis, right, in 08 and 09. And, you know, I think, you know, because I was working so closely with the company, I was able to stand up in front of my partners and say, it was really interesting because Box, the metrics were really fantastic. Like if the world had not been melting down, it would have been no problem. But they went out to raise a round of financing and just nobody wanted to do deals for a couple of months, right? So the market was sort of closed. And being able to stand up in front of my partners and say with conviction, this is a great company. Like this is a company we absolutely need to get through this period. And also to have, you know, one of the things that we try very hard is to have a team approach, which a lot of the best venture firms have. Have Emily as my, you know, second chair on the deal, who's also very involved, being able to do that. And being, you know, we ended up putting in, you know, our pro rata, you know, would have been X. We ended up putting like 3X our pro rata into a round. We basically did the whole round. Our co-investor did just pro rata, and we did everything else. Wow. And, you know, not only did that help get the company through that period, but also, you know, it turned out to be a fabulous investment for us. Yeah, increased your ownership percentage and. Yeah, but you know, more than that, actually it's funny. The ownership percentage usually only goes down from the first investment. Right. People don't often realize that, but you know, it certainly prevented a company that obviously has had, you know, tremendous growth and potential from, you know, prematurely ending. Oh wow! So is that serious? Oh sure. I mean, you remember that was like that was a tough time. Well, I don't remember. I wasn't, you know, doing a company specifically at that time, so I wasn't in the midst of trying to raise money. But I've been through other situations where all the doors are shut, and you know, you just got to come back 3 months later. You know. I mean, the Dow had gone off like 50%, right, in a year, year and a half, and so it was just, you know, it was very tough. The only thing that's analogous to that, I think, is that I've seen was the .com collapse. Right. And then, 9/11. Interestingly, less from a funding standpoint, but from a corporate. You know, when I was doing my company, you know, people always ask me like, well, what's the market like? And people want to talk about valuations. I'm actually more interested in are companies making long-term capital investments. Right. That's how I can tell sort of the fear-greed index. Yeah. Right now, they clearly are. So people are buying software, they're buying infrastructure. After 9/11, it was amazing. Like literally all the corporate purchasing stopped for a couple months. Yeah, that was tough. Very tough time. Yeah. All right. Well, let's see if we can take some questions and help some people out. So you can reach us by email to help@founderline.com.
And you can also tweet to @FounderLine, and we'll see if we can help you out. So first question today is from David in Toledo. It says, people talk about a valuation bubble. What would it look like if this bubble pops, and how can we hedge against it? What do you think?
Well, I think...
Are you bubble or no bubble? What's your... and if bubble, which bubble, or where is the bubble?
Yeah, it's a weird bubble. So, you know, I can compare it to the .com bubble, which is sort of the reference point for all bubbles in the tech world. You know, in that bubble, you had this kind of rising tide that lifted everything. So it was like, you know, if you put .com on a piece of paper and went to a VC, you know, you were getting funded. Yeah. And, you know, companies were going public like literally 14, 15 months after they were founded, and on $2 or $3 million, or sometimes less, of trailing revenue at hundreds of millions. I mean, it was... And
huge unprofitability, right?
Well, I mean, forget profit. I mean, they had no top line.
Right.
Not even, forget the bottom line. So almost by definition, huge unprofitability. I think, you know, you contrast that now, and if you're looking at companies that are either newly public or that are late stage private, you're typically talking about companies, typically, not always, but typically talking about companies that have hundreds of millions in revenue, some cases billions in revenue, right? If you're talking about like an Uber or an Airbnb, or in our portfolio, a company like a SpaceX, for example, right, you know, you're literally talking about 10-figure revenue, right? And so, you know, I think that all valuations at the core, all valuations should trace back to the sum of the discounted present value of a company's forward earnings, and the key being forward, not the earnings in the rearview mirror, because that's just cash. Right. And so the real question is, well, how optimistic are you about what those forward earnings are? Are they going to remain constant? Are they going to grow? And you know, that determines the kind of multiples people are willing to pay. Right now, I would say people are being very optimistic about forward growth. So they're giving companies a lot of credit about the rate of growth in the future, and so they're willing to pay higher multiples. The weird thing about this bubble is you have a big disconnect right now between the public and the private markets, where public markets are willing to pay, on average, about half of the multiples of late-stage private markets. And interestingly, it's sometimes the same people. And so you can say, well, okay, well, if that's the fact pattern, what would be the hypotheses? Well, one hypothesis would be that Silicon Valley understands how to value these companies better than Wall Street, and that Wall Street is just being wrong. You know, the alternative hypothesis, of course, would be that Silicon Valley is wrong and that Wall Street is right. I actually think the latter is probably more likely to be true. Right. One of the things about the public markets is you have much more transparency. You have much more granularity in that, you know, as a number of people like Jessica Lesson have pointed out pretty eloquently, you know, if I invest $10 million at a $1 billion valuation in a startup, does that really mean the whole company is worth $1 billion? It's very different than a company where the stock is trading every day, right? And people are kind of voting. You also don't have shorts. So, you know, there's no way to make money be negative on a private company in Silicon Valley. And also there's a lot of social pressure to not be negative because we're all optimists, right? We want companies to do well. Right. But I think, you know, the shorting function is a healthy way of sussing out shenanigans, basically. And I think public markets do better at that. Anyway, so long way of saying, I think we're in kind of a weird semi-bubble. I think the bubble is asymmetrically distributed in that you're seeing probably too many companies getting funded at the seed stage and very high valuations at the late stage. But then there's also kind of this tough round in the middle where it's actually hard to raise capital. Yeah.
The B round,
the
or
B
whatever
rounds,
it's being called now, right?
You know, I guess I would just close in terms of the hedging. My partner Heidi Roizen wrote an incredible post about the importance of terms versus valuation. And I think the best way to avoid getting caught in the bubble popping is, as an entrepreneur, if you're raising money, make sure that you're raising money not just at a valuation that's attractive to you, but also at clean terms. The most dangerous thing is raising money at too high a price and at terms like multiple liquidation preferences that come back to, or participating preferences that can really bite you.
And you know, those liquidation preferences are the things that a lot of entrepreneurs, hopefully they get good legal counsel and they can you know, understand what those things are. But I mean, that's tricky. Well, we'll give you $1 billion valuation, but we want a 3x, you know, participating, or you know,
well, there's an old banker joke where they say, you know, you name the price, I'll name the terms.
Right. That's
you know,
what's happening.
Yeah, I mean, I think you're seeing that to some degree, but there's much less mustache twisting, like kind of like, you know, haha, I'm gonna screw this company out of their riches. I think it's more that, you know, investors who are being asked to pay what are almost ludicrous prices for companies are saying, well, if I'm going to do that, which so basically I'm sacrificing my upside if things go well, I want downside protection. I think it's a better strategy, and one that I personally favor, is to take more of a, let's find a fair valuation on clean terms where we can be aligned with, we don't have terms that are pulling us out of alignment, and that, you know, if we do really well from here, everyone should make a lot of money.
Yep.
Right.
Makes sense. All right. Well, David, hope that helps. Let's go to Alex in LA, who says, how quickly do you make a decision on an investment? What are the key things you look for? Is it team, product, or something else?
Yeah.
So when do you know? Do you know in the first, 5 minutes, 10 minutes that, oh, there's something here?
Yeah. I think you know pretty quickly. I don't know if it's the first 5 or 10 minutes. Actually, I think the first 5 or 10 minutes can be really dangerous because you have to be aware of your own unconscious biases, and it can be like I mean, this has been all well documented, but it's you tend to have a preference for similarity, right? And so this is where some of the things with gender bias and ethnic bias comes in. I think but I do think within the first 10, 20, 30 minutes, you get a pretty clear sense of, is this a company that I want to spend more time thinking about or not? And that's kind of like the first screen. In terms of what we're looking for, every venture firm is different. Especially the later stage firms are going to be looking for, is this a company where if you're a late stage growth fund, for example, you're going to be looking for is this a company where the processes are solid, where the repeatability is high, where I know that if I put $50 million at the top of the sales and marketing pipeline, this much net income will come out the bottom. For us, it's usually an idea stage. The question we're asking ourselves is, if this works, how big can it be, right? And so if you're selling software that is optimization software for insurance adjusters in the auto space, that's kind of a niche-y sort of a market.
Right.
If you're saying, I have an idea for making cars obsolete, or I'm going to go after the entire aerospace industry, or this is going to displace email. Those are the big ideas. I wouldn't say it's actually so much about product. So for us, it's kind of market. It's like, how big is the potential market? And that can be really tricky. Like, there's a lot of head fakes there. Like Uber is one that we talk about a lot, where you had to what most people, including what I missed there, was the degree to which it could expand the market. Right, the market could be elastic. It's Uber is way bigger than the taxi market now. Right. And then people, and some VCs will debate, is the market more important or is the people more important? I tend to come down on the people, because what I found is really smart, motivated people they'll find the market.
Yeah.
But I think the magic also happens when you get both. And the really kind of mind warping thing can sometimes be that almost all of our companies are not exactly what we thought we were backing. All of our successful companies, there's always some twist along the way. And part of that is because if it was like obvious, if like all the conditions were perfect at the time of starting, there would be way too much competition and the big companies and all this stuff. So it's usually like something happens. Like, I'll give you an example with Box. Box was doing well, but it wasn't like kind of explosively growing. It was, still kind of single digit millions of ARR and growing, doubling, but like kind of, slowish. The iPad came out, and Aaron was like, between when they announced the iPad and they first started shipping it, Aaron was just say like, yep, we're dropping everything and we're just developing for the iPad. And man, that was a great call. Like,
and that's a tough decision, right?
Tough decision, yeah.
Like 30 things on the drawing board.
Totally. Yeah. It was like a web. It was a web app, and and mobile was totally transformative for Box, because all of a sudden you had, the iPad was like this kind of wedge combined with the iPhone for BYOD. So, IT guys who had said, well, it's Microsoft all the way, and these are the Microsoft and RIM, and you're using these tools. All of a sudden, people said, nope, I'm going to use my iPad.
I paid for it.
I paid for it.
Yeah.
I'm going to bring it in. It didn't have a file system. You couldn't like copy files to your iPad, so you had to have some way to get the content on there. And so it was like kind of all that stuff came together. And then I remember, 6, 12 months later, it was like, you talk to the sales guys, and it was like, if in the Salesforce opportunity record, mobile was listed as like one of the key drivers, it was like our win rate was like 95%. Wow. It was crazy, right? So you kind of got to get lucky like that, right?
Absolutely.
Yeah.
All right, good. Well, I hope, Alex, I hope that answers the question a little bit. Let's go to one more before we do sponsor thank yous. This one is from Mikey in New York. How do you envision deal terms changing, if at all, for later stage investments due to the greater amount of non-traditional investors, i.e. mutual funds, coming in, given their different risk tolerances and liquidity expectations? So we talked a little bit about some of this stuff, but what do you think? What do you see changing there? Boy,
it's a really good. You have good viewers. It's a good question.
We try. We pay them well.
What's going on at the late stage right now is really interesting in that you have companies that are able to raise effectively private IPOs and relatively large private IPOs. I mean, historically, $100 million would have been an IPO round.
Absolutely.
Or even 50.
Yeah, a market cap of 300 was awesome back,
Yeah. And so, for the last several years now, it's been for really successful companies. And, we mentioned before, you have companies that are doing hundreds of millions in revenue. They're able to raise very large amounts of capital privately. One thing I've seen recently, just in the last month or two, is, and a lot of that's coming from the mutual funds and the groups, and those investors are looking for alpha, for excess return, because when the companies are going public so late, there's less of it there. And it's interesting. People would assume that like a Fidelity or a T. Rowe would actually want to have more liquidity. They're actually very comfortable with holding these securities for quite a long time. Part of it is, you're talking about people that are managing, trillions of dollars, or certainly hundreds of billions of dollars. And so these are just rounding errors in their funds to some degree. But they're also building long-term portfolios, right? And so, they have seen with companies like Facebook, and now with, Uber would be a great example, where Uber, by market cap, is one of the larger companies just in the world. And so they feel like they need to own that. I mean, if you're Fidelity, you want to own the entire stock market.
So get in now before,
Well, it's either get in now or don't get in at all, right? And so you see a large section of economic growth that's just not accessible to you. So they've all figured out ways to do this. One interesting thing is one of the pressures for companies to go public, beyond the transparency, like in the enterprise, customers usually want to see our financials, is employees at some point say, hey, we've been working at this for 7, 8, 9, 10 years. Is like to buy a house. I'd like to have some liquidity. Those funds are now stepping forward and doing tender offers privately, where they will say, and this is only for the best and biggest companies. We will buy $50 million of employee stock. The company will set rules for how that's done, and maybe it's, let's say, 20% of your total holdings, and only if you've been there for 2 years, and whatever. But it's allowing employees at some of these top companies to start generating some real liquidity.
That's kind of cool.
And it is cool, and it's taking a lot of that pressure off as the IPO. I think the good news about that is, as a private company, you're able to be much more open in your planning. So you haven't committed yet to the Wall Street treadmill of, these are the financial targets, we can't deviate. The classic example would be, you see a huge opportunity, but it's going to require, let's say, a $50 million investment. If you're a public company, it's very tough to go to the street and say, I know we said we were going to have net income of $10 million this year, but it's going to be negative 40 because, trust us, we have this great idea. It's very tough.
What do you think that does to the stock that day?
Totally. And as a private company, you can do that. The downside is, I think you can also start smoking your own exhaust, because you don't have the scrutiny of Wall Street. Does serve a useful function of also just kind of, keeping an eye on things. I actually think this is one of the roles of investors in general. Is when I was an entrepreneur, I was in the forest every day, right? I mean, it's like with my kids. I see them change a little bit every day, so it sort of sneaks up on me. If you see them every 6 months or every year, you see the changes.
Yeah, you're like, your relatives are all, look how tall he is, right? And you're like, oh yeah, he is tall now.
And so that's where, that's one of the functions of a board, right? A good board and good investors. But I think it's a positive thing. It'll be fascinating to see. At some point, you do need to have the transparency. And what keeps me up at night is I worry there will be some big scandal, because auditing standards, for example, are much looser at private companies. And as you start talking about larger and larger amounts of money, now you're talking about the widow and orphan money, where you're going to be losing money on behalf of some pension fund or something.
Because they didn't have to go through the scrutiny of
there'll be fraud.
Process,
I mean, there'll be fraud, and there'll be some issue, and it'll be interesting to see how everyone reacts to that.
All right. Well, Mikey, hope that helps. We're going to take a minute here to thank our sponsors, so relax for a minute. We really love the support that we get from our group of amazing sponsors, and for this season, it is Oric, Square One Bank, Accretive Solutions, and Ustream. And I want to start with Oric. Mitch Zuckley, who's the chairman over there, is someone I've worked with on a number of companies in the past and has been with us from the very beginning. Just a great supporter of FounderLine. And I'm always talking with founders about their situations in growing their companies. And one of my earliest pieces of advice is to make sure that you get a great lawyer, not so much because you just want somebody who's going to do your paperwork for you, your financing documents and your employment agreements and all that sort of great stuff, which is sort of table stakes. But you want someone who's going to be one of your most trusted advisors, who has seen way more situations than you'll ever see, whether it's pick a topic, financings, hirings, firings, partnerships, whatever. So you want to have somebody who has that background and can say to you, Joe, that's not really industry standard. You probably don't want to accept that 8x liquidation preference right now. So so make sure you get a great lawyer. The team over at Oric has been very helpful to me over the years, and you can go read more about them at their website. Their URL is oric.com. Next, I want to thank our new sponsor for this season, which is Square One Bank. And I've been working with Sam Baumick and Lori Lumenti-Gardi over there for a number of years. They're supporting us now through this process. And of course, once you raise that money from DFJ, you want to make sure you put it in a great spot, make sure that it's secure. But beyond that, that's sort of the basics. Every bank is going to ensure that happens. You want them to make your life easier. So things like online banking that really works well, company credit cards, so that as you're growing the company as a person, as a founder or CEO, you don't have all this debt outstanding on your personal credit card that if something bad happens, you're stuck with it. So the team over there can help you out with those sorts of things. You can find out more at their website. The URL is squareonebank.com. It's square with the number 1 bank.com. I also want to thank Accretive Solutions. They're the leading business outsourcing firm in Silicon Valley. And I had to ask Martini, who's my contact over there, what is business outsourcing? I knew what she did. She was my temporary CFO, but it's basically running your finance function for you until you get large enough to need to hire a full-time CFO and controller and accountants and all those sorts of people. When you're in the earliest stages, you want someone who's going to make sure they're keeping track of everything. The bills are getting paid, payroll's being done, properly and legally. Just taking care of all that stuff, board packages on a regular basis. And as a founding CEO, you could be spending your time, monkeying around in QuickBooks, or you could be spending your time hiring more people or doing something more critical to your business that someone else can be taking care of for you. So Accretive can do this very cost effectively for you. They've done a great job for me with multiple companies now. You can find out more at their website. It's as-bos.com. And then finally, I want to thank the team over at Ustream. When we first got started, Brad Hunstable, who's the CEO over there, said, we want to be supportive of what you guys are trying to do in helping out entrepreneurs, and we'd love to work with you on this. If you're a company that's thinking about doing corporate meetings or any kind of live video streaming, maybe you want to do a show of some sort and broadcast, Ustream can help you out with that, and they've done a tremendous job for us. I'm sure they do the same for you. You can find out more at their website. It's ustream.tv. So that's it. I'm almost out of breath. Let's go back to some questions, and we got about 20 minutes left here to blow through a bunch of stuff. So Terry in SF says, do you think there are types of businesses better or less suited to starting off with funding from Kickstarter, Indiegogo, or the like? So have you funded any companies that have done those sorts of things? Yeah, I'm trying to think. So my DFJ's founding partner, Tim Draper, is a personal investor in Pebble. Cool. But I don't know which I think is the record holder on Kickstarter. Yeah. They raised like $19 million for their last product.
we've looked at a lot. Oh, you know what? We did do one actually. Karma, which is a Wi-Fi hotspot, did I believe a Kickstarter in Indigo. Where I think they can be super helpful is actually they're not really funding. What they are is pre-selling product.
Exactly. Pre-orders.
And
right.
pre-orders. And I actually think even more than the money, if you're trying to build a company of real scale, it's showing the product market fit, right? So if you can go to a bunch of investors and say, I've literally pre-sold $5 million of my product, that's a lot better than any market research you're going to do. Yeah. So I think that's actually the most compelling part about them is this ability to pre-sell before the product actually exists. It reminds me of my one of my good friends, Naval Ravikant from AngelList.
Yeah.
It was this sort of very prolific, came up with all these ideas. He used to run Google ads for non-existent products with landing pages just to test conversion before he decided if he wanted to keep working on them or not.
Really?
Yeah, and I just think that's like, it would just say, like, here's a service, and if you're interested, coming soon, put in your information, we'll let you know. Yeah. But it was a way for him, like kind of as like a first order principle for him. It was like, is this going to be easy or hard to sell? That's the beauty of Kickstarter, which is you're literally just putting your idea out there, yeah. And yeah, I think it's really cool.
One of the things I learned in the course of, I think it was Presto, was a lot of times that happens in the infomercial world. Like
sure.
Those products don't actually exist.
Yeah, they're just seeing who calls.
And you get all the calls. You can't actually charge their credit cards. Like
yeah.
There's a law. Yeah, I forget if it's like 30 days or
yeah.
60 days or something like that. And so you just say, here's my budget. I'm going to go run this, yeah. Ron Popeil's, whatever sure. gadget. And if people call up, if the phones light up, then you call China and you start making them. So same sort of thing. I didn't know Naval was doing that with Google Ads.
Yeah. Well, this was like 5, 6, 7 years ago.
Yeah, no, it's great. So Terry, hope that helps. Let's go to Larry in Mountain View. It says you served on the boards of the Center for Venture Education and the Kauffman Fellows Program. Tim Draper started BizWorld and Draper University. This guy's done his homework. Barry Schuler and Sam Fort work on education programs.
Holy cow.
DFJ is partnered with Stanford on the Entrepreneurial Leaders yeah. Fellowship, and so on. Is a concentration of effort on education, especially education of young entrepreneurs, a specialty of DFJ? Like, is that something you guys say, hey, we got to go do this, or is that just a coincidence?
I feel like that's got to be a plant question from one of. Oh, it's amazing. Okay, you've very.
From one of your.
That's.
I don't think it. I don't think it had a DFJ.
That's fantastic.
Wait. Let me check. tim.draper@gmail.com. What is that? No, I'm kidding. I don't think it is.
Yeah, I think it's something that we care deeply about the ecosystem, and I think it's a way for us to give back, right? And so I think. One of the things that was mentioned was Stanford. So we have a partnership with Stanford for something called the Entrepreneurial Thought Leaders series. Fabulous program, actually.
That's the Tina Seelig.
Tina Seelig, does that, and we've sponsored that for years. And I would highly encourage people to go. I mean, they have incredible founders. I mean, just like the A-list founders go through there and speak for an hour about their experiences to reasonably small groups, like a couple hundred people.
Yeah. And
then it's all available online as well. And for us, that's just part of like building the community and building that kind of knowledge set, because we're at the margin. We're trying to the more people that are out there starting companies and pursuing their passions, hopefully we'll get a chance to fund some of them.
Cool.
Yeah.
Well, we'll do a full investigation to see if Tim Draper is behind that question.
Yeah, exactly. Check the IP address.
Yeah, exactly. We'll get on that. So this one is from Michael in San Jose. Are there a lot of founders out there that you don't feel are qualified? What qualifications do you generally see missing? Should they give up on founding, or is there something else they can do to fix their situation? So you don't have to name names if there's somebody specific you'd like to call out here. But
other than myself 15 years ago, I think it's very, you've been there. It's very, very hard to start a company, and the odds are pretty long, especially if you're talking about at the idea stage. And I think the least successful group as a whole are the people who just want to start something to start something. They'll say, I really want to start a company. I just need the idea. And I think that's coming at it kind of backwards. The best companies come when someone has an idea and it's just like, you just can't get the idea out of your head. And it's often something where you'll have some direct experience. So like a very typical thing will be, I've been working in this industry X. I saw a very interesting company recently where it's involved in the shipping containers and freight forwarding for like cargo ships. And the guy had been working in the industry for a couple of years, and he's like, this is the way that this industry operates is completely backwards. It's like, they're doing everything wrong, and here's how I would do it.
And they would know, right? Because they're the domain expert.
Yeah, totally. And I think, so there's usually something like that. I think with the availability of the seed capital, the other thing is, before you start a company, you really should have worked, I think, at a couple of companies, ideally. I mean, there's always exceptions, right? Like, Mark Zuckerberg's example or Aaron Levy. But, it really helps if you've worked at a company, if you've kind of like you've seen other people make mistakes when it's not on your dime.
Yeah.
You've learned good things from talented entrepreneurs who have done it before. And then you build that network of people that right? That like people who then want to do it. What often goes hand in hand with I want to start a company is I just need a technical co-founder, or I just need a co-founder, period. A first principle test for us is going to be if you can't get 3 or 4 brilliant people to follow you, why would we think you're going to be able to get anything else to happen? So that's almost like, with a few exceptions, the kind of the solo founder who doesn't have a team together yet, or says, well, I have a team and I'll join once I'm funded, that's almost always kiss of death.
I was thinking about changing my name to Elon Musk. Do you think that would work? What do you think?
Yeah, that's probably dubious legally, but I think with the right kind of hairstyling, you could get there.
Slightly spelled differently, I think, but
yes, with an A.
Yeah,
Elon.
Yeah, exactly. Yeah. So. All right, Michael.
But talk about somebody who's super compelling, right? I mean, I actually think if you say what's Elon's great gift, I mean, he has so many gifts, but like one of them is his ability to compel people with a narrative and what the thing could be and how big it could be is incredible. Not just the employees at Tesla and SpaceX and SolarCity, which we were lucky enough to back all 3 of those, but like just the world. I mean, people just follow what this guy says because he's fascinating. It's Steve Jobs was like that, right?
Yeah. It's pretty amazing. So, all right, let's go to another one here. This one is from EC in San Mateo. I'm considering joining a startup, and I have 2 options. One where I've worked with the founders before and believe in them, but don't really believe in the product. And the other where I believe in the product, but don't know the team. I'm leaning towards joining the people I know. Do you have any advice in helping me make this decision?
Gosh,
interesting.
That's a tough one.
Yeah.
I think that at the end of the day, you should follow, the best test is going to be what's going to get you excited to get out of bed every day and go to work and spend 16 hours there. And if you really don't believe, the people are the most critical thing, and actually probably the biggest risk factor of joining a company when you don't know the people is there's no way to really get to know them in a short process of time versus if you've been in the trenches. I always say, like, if you've been to war with somebody, if you've been, my co-founders from my company, I know them as well as I know my wife, right? I mean, just because of the stuff we've been through.
You see how they react during
totally
the very
emotional,
times.
very intense emotional things, right? If you don't believe in the product and it's not a product that captures your passion, then the question I would say would be, do you have enough passion for working with the people that doesn't matter, or could you find the passion for it? But otherwise, I would probably.
Or maybe change the product even, right? Like.
Well, maybe it's their passion though, right? I mean,
that's true.
So the question really may be, well, why don't you believe in the product? And if you believe in the people, maybe we would challenge them, and I would say, hey guys, I love you. Not really so sure about this product you're going after. Help me understand, why are you so jazzed about it, right?
Yeah. Like I would almost say don't go to either, because I mean there are problems in both of those. But I agree with you. People is one of the most critical things. And actually, as I look at opportunities now, if the people aren't awesome to begin with, like not it's like end of story. I don't care what they're working on, right? It could be something I'm really interested in. You can't fix that. But if you're going to go work with someone in the trenches every day and you don't believe in the product, like you're kind of I don't think it's going to last very long. So I don't know.
Yeah, no, and I would say hopping around a lot is not a good idea. You want, and there's a big cost for picking wrong.
Yep.
Right now. Yeah.
All right. Well, good luck, EC.
Yep.
I hope that's a little bit helpful. Let's go to Sharon in New York City. How does DFJ make a decision to invest in a revolutionary technology that may or may not pan out and are in the distant future, like SpaceX, Planet Labs, Tesla, SolarCity. Your portfolio seems to have more than a few of these types of investments, and some of them are succeeding. Are these higher risk than other investments? So, you know,
I feel like that's a backhanded compliment, but
I think so.
First of all, thank you for noticing.
Yeah,
we do pride ourselves on, you know, our motto is think big.
That one's from Tim as well.
That's sure. Probably yeah, and some of them are succeeding. You know, we do pride ourselves on kind of going where others fear to tread, and you know, I think SpaceX would probably be a great example of that, where, you know, on paper it has everything wrong with it. You know, you're very concentrated customers, hugely capital intensive, you know, kind of very, you know, when you talk about an MVP for a rocket, it's,
things,
you know,
blow up occasionally.
Things blow up occasionally, though we've had a pretty good run going there, 18 in a row before that. But yeah, no, I think, you know, the thing about those opportunities is they also can tend to be some of the most revolutionary. So going back to the how big can it be?
Right.
You know, Tesla wasn't aiming when Elon and actually Martin, who was the original CEO there before Elon jumped in as the full-time CEO, came to pitch us. You know, the first product was the Roadster, but Tesla was never about the Roadster. The Roadster was always a stepping stone to the Model S and then to the Model 3 and to the
almost the Kickstarter for.
It was, yeah. I mean, it was, and you know, the going back to the kind of the storytelling, I think one of the key insights that they had was previous attempts at electric cars had made the mistake of trying to create a product that appealed to this sort of very hardcore environmental set, and they either looked really goofy, like that kind of bullet-shaped Honda, or they weren't that fun to drive.
Right.
And so what these guys realized was actually electric motors are really, if you've driven Teslas, you know, they're really fun to drive.
I know.
And this, yeah, you go. I think this could be, you know, and so they built basically like the most kick-ass car that they could think of, and it just happened to be electric, and it kind of opened everybody's eyes to that. And you know, so I think, so how do we invest in these big, complex ideas? You know, a lot of it is a leap of faith, but a lot of it is also, you know, for each one that we do, we are saying no to dozens and dozens. And my partner, Steve Jurvetson in particular, has an incredible nose for being able to suss out which of these. And you know, one of the things that as a partnership we'll then push on him on is, okay, well, let's talk about all the various risks that can happen. So funding risk is usually a big one for these big companies, because we're a reasonably good-sized fund, but we can't support a company indefinitely by ourselves.
Yeah. We need $1 billion. You know, like
totally.
It's kind of hard to do on your own.
Well, and Tesla did. Tesla needed several $1 billion. It turned out, and that was one of the major risks. But you know, we're in the risk business, and so you know, for us, it's risk versus reward. And a big part of the risk that we were underwriting in that investment was the bet that that Elon would be able to pull that off and bring that funding together. We actually love those investments. The kind of, we call them as a bucket, we call it disruptive technology. It includes things like quantum computing, 3D printing. We have an autonomous vehicle investment that we haven't announced yet. We have stuff in synthetic biology. We have a company that is being led by a guy named Craig Venter, who decoded the human genome, and that company's called Human Longevity. They're literally trying to cure death and old age. So it's, I mean, it's like losing a little big market. That's what I always say, right? I'm pretty sure that curing death will be a big market.
That might even go global, you know.
But you know, they're trying to dramatically extend the human lifespan.
That's pretty cool.
Big long bet, but man, you know, I mean, you know, people will pay a lot for another 20 years.
Yeah, that's great.
Yeah.
All right, well, Sharon, hopefully that gives you a little insight. We've got a few more here before we run out of time. Bobby in Dallas has a question. When you are making an investment, how quickly do you know that you're going to invest or not invest? We talked a little bit about this. Do you get a gut feeling in the first few minutes and then spend the remaining time in diligence confirming your initial gut reaction? So we covered some of this earlier.
Yeah, I mean, it's there's definitely a big chunk where you just say, no, this isn't for me. And I'd say there's like, you know, 20 or 30% where you say this is not going to work. Part of it is before people who come to actually pitch us, or we're screening well before that, right? So the people actually pitch us, it's actually maybe 20% where you just say this is just going to fail. There's a bunch where you just say this isn't the right deal for me. It's not, you know, or DFJ, this is not something we're really good at. So for example, anything that would require FDA approval, highly specialized, we just try and steer away from those.
Got it.
We've learned that consumer hardware is not something that we're especially good at. people can do it, like Roku, great company that you're involved with. But it's just not something that we're good at. And then I would say, diligence for us is about making sure, it's less about kind of trying to talk ourselves in or out of an opportunity. It's more about making sure we understand that the risks are what we think they are, and that we have accurately assessed the risks. The trick with diligence is, my favorite one is you do reference calls, and if you talk to experts, they will almost always tell you that this thing's a horrible idea because it's not how things are being done right now.
Right. It jeopardizes their job security in many cases,
right? Totally.
Yeah.
And so, it gets easier as the companies get later because you're talking to customers. But, most of our diligence is about, do we understand the risks as they exist? Doing some confirmatory stuff if our customers, how are customers using them? And actually, we do a lot of reference checking on the founders themselves. Less kind of, people always think, oh, we're looking for do they have a criminal record or something? It's actually more like talking to people that have worked with them to say, how does this person think? How do they react under pressure? How would we bring out the best in them? What's the best? We pride ourselves on being very adaptable in our style. So my persona on a board is very different from company to company because I try to be, the director the company needs me to be, not the director that I am. I think that's, we're in a secondary role to the entrepreneur. So you want the entrepreneur to be who they need to be and what makes them best, and then we sort of fill in where we can.
That's good for VCs with multiple personality disorders, right?
Totally. Well, we're all we all schizophrenic.
That's great. I was going to ask you, how do you say no to people? Like if you get an email pitch, over the wire, and it might come from a referral or whatever else. Are you a quick no? Like, hey, this just isn't an area that I'm interested in pursuing, or how do you handle those? Because you have to say no way more times than you say yes, right?
Yeah. Yeah, I mean, I try to, so having gotten a lot of no's myself, what I always hated was the VC that would say, hey, could we talk at 5 o'clock tonight? Or could you get on the phone? Because it was like, if it was 11 o'clock, I was ruined for the rest of the day waiting for that call. Because I didn't know which way it was going to go. And you kind of know, it's probably not a yes, but you're not totally sure, right? So what I usually do now is I'll send someone an email and I'll say, hey, it's a no. We're not going to get there for whatever reason. I usually try to give them 2 or 3 kind of high-level thoughts, and then I say, and I'm happy to hop on the phone with you for 5 minutes if that would be helpful. And I would say maybe a third of them take me up on it, and I try and do it. The trickiest part about it is, for the vast majority of cases, it's not like I'm saying your business isn't going to work. It's just not, for whatever reason, the right fit for us.
Right.
And so, what I usually say to people is, but I'm really rooting for you, and I am. It's actually one of the worst parts of this job is all the companies I've said no to that end up being huge, massive successes, and it's very humbling. But it's hard. I mean, I know how hard it is. You put your heart and soul in it, and you really want people to say yes. Right. And I think it's important to think of it as a process and not a contest to be won.
Yeah. Well, and I think a lot of people, they don't think about fit, right? They think,
totally.
Oh, well, Josh is saying no. He's saying my business sucks.
Yes.
And that's not what he's saying, right? And just because he is not the right investor or DFJ is not the right investor doesn't mean that somebody else, isn't the right investor.
Well, and by the way, I mean, I would say trying to argue with the person and turn them into a yes right then is rarely going to work. But I've had 2 examples. One, a company called Chartbeat with an entrepreneur, Tony Hale, who's an incredible entrepreneur. I said, look, here's my concerns. I said, thank you. 4 or 5 months later, he came back and he said, I've made the following progress against your concerns. And he convinced me, right? And so that was one where I'd said no, and then I said yes. My most recent investment in a company called TalkDesk, the COO of TalkDesk, Gotti, had pitched me a year and a half ago on a company where he was the CEO. I'd said, we're not going to invest, and here's the thing. We must have had a good interaction because he called me up around January this year, and he said, hey, we shut that company down. I've joined this new company as COO. It's blowing up. You should hear about it. And so it was great. And so sometimes it's not a fit here. Right. Elon Musk pitched our partnership on Zip2, which was his first company.
Oh, right.
And it was a no. And then we gave him a term sheet on PayPal or on X.com, which became PayPal, and didn't win that term sheet. But then we finally got to work with him on Everdream initially, and then Tesla, and then SolarCity and SpaceX. So it's funny, like it can really come around. It's never burn bridges or relationships, and just don't take things. It's hard not to take things personally when you're putting so much of your effort into it. But
yeah, it's hard as a founder.
Totally.
But I always try to maintain that relationship and tell them, hey, if you think I can be helpful somehow, let me know. I'm not investing, but I'd love to see if I can help you out somehow.
I think a lot of the dysfunction actually that people see in VCs comes from it's hard to tell people no all the time, and so you like kind of get like a little distant and cold because you're like internally dreading the having to.
Yeah.
So I just think that's where having been on both sides of it helps a little bit.
Yep. Well, we're out of time, sadly, so we couldn't get to everything, but we got to a lot today. Thanks for being such a great guest.
Thanks for having me.
Really appreciate it.
Great viewers.
You can follow Josh on Twitter. His handle is DFJ Josh, 2 J's in there, and the firm is DFJ VC is the Twitter handle. Tune in next week for another episode of FounderLine. Our guest will be Satish Damaraj, who's a partner at Redpoint Ventures. Satish was a founder and early executive at a bunch of companies, OneBox and eventually Zimbra, and now he's an investor in companies like Sonos, Coin, Nextdoor, and Pure Storage. It's next Wednesday, July 15th at 5 o'clock Pacific time. Thanks again to our fantastic sponsors, Oric, Square One Bank, Creative Solutions, and Ustream. And don't forget to follow us on Twitter. Our handle is @FounderLine. You can email us questions in advance for Satish to help@founderline.com. You can go to our website where you can check out previous episodes. You can read about the upcoming guests, and you can also subscribe to our podcast on iTunes. Thanks for watching. Here's to the crazy ones, and we'll see you again next time.